Rocket Lab stock just did something wild. After climbing from $87 to nearly $100 in early January, it's now sitting around $88, down almost 20% from those recent all-time highs. And here's the thing, this happened right after they announced that one of their Neutron rocket tanks literally ruptured during testing. Now, if you've been watching the headlines, you've seen everything from Rocket Lab faces major setback to analysts remain bullish despite test failure. So what's the actual story here? Look, I've spent the last week diving into the earnings calls, reading analyst reports, and honestly, this situation is way more nuanced than the headlines suggest. And that's exactly what we're going to break down today. We're going to talk about what really happened with that tank test, the $816 million defense contract that changes everything, why Morgan Stanley just raised their price target to $105, and most importantly, whether this stock at $88 is a screaming buy or a value trap. So let's start with Wednesday's trading action because this is where things get interesting. On Wednesday, January 28th, Rocket Lab closed at $88.57, up 1.8% on the day. That might not sound like a massive move, but here's what caught my attention. The stock traded on just 16.1 million shares. That's 41% below the average daily volume. Now, why does that matter? In technical analysis, when a stock bounces on lighter volume after a significant drop, it often tells you something important about market psychology. The sellers are exhausted. The people who were going to panic sell have already sold, and what you're seeing now are the long-term holders stepping in. Think about it this way. If you're a retail investor who bought at $95, saw the tank rupture news, and immediately sold at $75, you're gone. You're out of the equation. But if you're a hedge fund or institutional investor with a 5-year time horizon, you're not selling because of a test failure that was actually expected in the development process. And speaking of institutional investors, this is crucial. 71% of Rocket Lab is owned by institutions. That's not retail money. That's BlackRock, Vanguard, ARK Invest. These are the players who provide price support during volatile times. Now, we did see some insider selling earlier this month. CFO Adam Spice and insider Frank Klein trimmed positions, which always makes headlines. But here's the context nobody mentions. This is completely normal for tax planning and portfolio diversification. These weren't emergency exits, they were planned transactions. The real question is, what are the institutions doing? And the answer is, they're holding. Some are even buying. Alright, let's talk about the Neutron tank failure. On January 21st, Rocket Lab announced that during qualification testing, the Stage 1 fuel tank of their Neutron rocket ruptured during what's called a hydrostatic pressure test. Now, the after-hours reaction was not great. The stock dropped more than 10% immediately. People freaked out, and I get it. Headlines screaming rocket explodes are scary. But here's what actually happened and why the experts aren't panicking. First, this was a qualification test. That means they were intentionally pushing the tank to its absolute limits and beyond to see where it would fail. Rocket Lab's statement was very clear. We intentionally test structures to their limits to validate structural integrity and safety margins. This is standard aerospace engineering. You want to know the breaking point on the ground, not in flight. Second, and this is key, there was no damage to the test facility. Nobody was hurt. The tank failed in a controlled environment, exactly as designed. The next tank is already in production. Peter Beck, the CEO, put it perfectly in an interview with CNBC. I don't believe in the approach where you collect good data, but it blew up just off the pad. That's not success for us. Success is reaching orbit on the first try. This is a fundamentally different philosophy than SpaceX's rapid iterative testing, where they literally blow up rockets on the pad to gather data. Beck is saying, we're going to figure out every possible failure mode on the ground first. Is that slower? Maybe, but it's also lower risk. Now, the big question everyone's asking, how much does this delay Neutron? Rocket Lab hasn't given a specific timeline update yet. They said they'll address it during the Q4 earnings call on February 26th. But here's what we know. The original target was Q1 2026. Most analysts now expect mid 2026 as the more realistic window. Is that a delay? Yes. Is it catastrophic? Absolutely not. Bank of America came out 2 days after the tank news and reiterated their buy rating. They actually raised their price target from $60 to $120. Their analysts call this routine and necessary within the context of launch vehicle development. Think about that for a second. The tank literally collapsed, and one of the smartest aerospace banking teams in the world doubled their price target. Now, here's the part of the story that doesn't get enough attention. In December 2025, Rocket Lab announced the largest contract in company history, an $816 million deal with the US Space Development Agency to design, build, and operate 18 advanced missile tracking satellites. Let me say that again, 816 million for one contract. But the number isn't even the most important part. What this contract represents is a fundamental shift in how the US government views Rocket Lab. For years, Rocket Lab has been the small launch provider, the company that could put your CubeSat into orbit reliably and cheaply. They were the Uber of space, convenient, efficient, but not mission critical. This contract changes that narrative entirely. This is a tracking layer tranche 3 contract. These satellites will detect hypersonic missiles, track ballistic threats, and provide real-time data to the US military's integrated defense systems. This is national security infrastructure. And they didn't just get the contract to launch these satellites, they're building them, they're operating them, they're providing the proprietary Starlight protection sensors. Rocket Lab just became a prime contractor for the US Space Force. Let that sink in. They're competing directly with Lockheed Martin, Northrop Grumman, and Raytheon for defense dollars, and they're winning. Now, here's why this matters for the stock: revenue visibility. This $816 million will be recognized through 2029. That's predictable recurring revenue. Wall Street loves predictable revenue because it de-risks the growth story. The company's total backlog is now over $2 billion. 2 years ago, it was under $500 million, and this isn't just one contract. Defense Secretary Pete Hegseth visited Rocket Lab headquarters last Friday as part of his Arsenal of Freedom tour. That's not a courtesy visit. That's a signal that Rocket Lab is now viewed as a strategic defense partner. Peter Beck has been very clear about the company's pivot. They're not just a launch company anymore. They're a space infrastructure company. Launch is one business line, the Space Systems Division, building satellites, components, spacecraft, that's growing at 55% year over year and now represents 45% of total revenue. This is the Tesla story all over again. Everyone thinks it's a car company. Then you realize they're an energy company, a software company, an AI company. Rocket Lab isn't just a rocket company. They're becoming a vertically integrated space platform. Okay, enough about the narrative. Let's talk cold, hard numbers. Q3 2025 revenue, $155 million. That's up 48% year over year. Let me put that in perspective. Most mature aerospace companies grow at 5 to 10% per year. Rocket Lab is growing at 48%, and they're accelerating. Analysts are projecting 2026 revenue around $900 million to $1.2 billion. By 2028, we're looking at potentially $1.3 billion in revenue. Now, the elephant in the room: profitability. Rocket Lab has never posted a quarterly profit. Q3 2025 losses were about $50 million. Full year 2024 losses were $190 million. So how can a company losing $190 million a year have a $47 billion valuation? 2 words: growth trajectory. This is a classic high-growth tech company model. You burn cash to build infrastructure, develop products, and capture market share. Then once you reach scale, margins explode. Rocket Lab's gross margin in Q3 was 37%. That's actually really good for a hardware company. For context, Boeing's gross margin is around 12 to 15%. The reason they're not profitable yet is because they're spending heavily on Neutron development, about $360 million total through the end of 2025. But here's the beautiful part: that spend is almost done. Once Neutron flies, R&D expenses drop dramatically, launch cadence increases, Revenue per launch goes from $8 million for Electron to $55 million for Neutron. The unit economics completely flip. Adam Spice, the CFO, said in the last earnings call, "We have the financial resources to bridge the gap to profitability. Neutron will be the catalyst." Now let's talk about Electron for a second because this gets overlooked. In 2025, Electron launched 21 times. That's a company record. They have a 100% mission success rate for the year. They just signed 17 new Electron contracts in Q4 alone. The backlog for Electron launches extends into 2027. This is important because Electron is the cash cow that funds Neutron development. It's profitable on a per launch basis, it's reliable, and demand is accelerating, not slowing. The bull case isn't just about Neutron. The bull case is Electron keeps generating cash, space systems keeps growing at 55%, defense contracts keep coming in, and Neutron unlocks a massive new market. That's optionality. That's a diversified growth story. Okay, now let's talk about the big question everyone has. Can Rocket Lab actually compete with SpaceX? Because let's be real, SpaceX is a monster. They launched over 130 times last year. Falcon 9 costs about $67 million per launch and can carry 17,500 kilograms to low Earth orbit. Neutron is targeting $55 million per launch and can carry 13,000 kilograms. So Neutron is cheaper per launch but carries less. On a cost per kilogram basis, they're roughly competitive. Neutron at about $4,230 per use, Falcon 9 rideshare at around $6,000 per key. But here's the concern some analysts have raised. And I want to be honest about this because it's a real risk. SpaceX could just lower prices. Elon Musk's internal cost to launch Falcon 9 is estimated at around $15 million. That means he has massive margin to undercut competitors if he wants to. If Neutron starts taking market share, SpaceX could drop Falcon 9 prices to $50 million and still make money. That would eliminate Neutron's pricing advantage. There's also the insurance issue. New rockets have higher insurance costs, typically 8 to 10% of the launch cost. Falcon 9's track record means insurance is only 1 to 2%, so a $55 million Neutron launch becomes $60 million after insurance. A $67 million Falcon 9 becomes $68 million. That gap narrows real quick. So, is Rocket Lab screwed? Here's my take. First, the market is big enough for multiple players. There are over 100,000 satellites projected to launch by 2030. SpaceX can't launch everything. They're capacity constrained. Second, Rocket Lab is positioning Neutron for markets where Falcon 9 is overkill, medium-sized constellations that need 10-20 satellites but don't fill a whole Falcon 9, national security customers who want launch diversity and aren't comfortable being 100% dependent on SpaceX. Peter Beck said it perfectly. Government and commercial partners are looking for launch diversity. There's a general uneasiness that there's really nobody competing in this class of vehicle. Translation: customers don't want to be held hostage by one provider, even if that provider is amazing. Third, and this is critical, Rocket Lab has something SpaceX doesn't: vertical integration in satellite manufacturing. They can offer you a package, we'll build your satellites and launch them. SpaceX only does half of that equation. For constellation operators, that's incredibly valuable. One vendor, one contract, full accountability. Amazon's Project Kuiper, OneWeb, SDA constellations. These customers want turnkey solutions. That's Rocket Lab's moat. Is it enough to justify a $47 billion valuation? That's the $47 billion question. Alright, let's lay out both sides of this trade clearly. The bull case. Number 1. Rocket Lab has a $2 billion backlog. That's not speculative, those are signed contracts. Number 2. They're growing revenue at 48% annually with improving margins. Number 3. The defense pivot is real. This isn't just a commercial launch company anymore, it's a defense contractor with strategic importance. Number 4. Electron is proven. They have the second highest launch cadence in the US after SpaceX, and they're profitable on a per launch basis. Number 5, Neutron unlocks a $10-15 billion addressable market. Even if they capture 10% of that market, we're talking billions in annual revenue. Number 6, the technical risk is manageable. The tank test was literally designed to find the failure point. That's good engineering, not bad luck. Number 7, Peter Beck is one of the best operators in the industry. He's delivered on Electron. He built the company from scratch in New Zealand. This isn't a Nikola situation. This is real hardware, real launches, real execution. And number 8, the macro environment is perfect. Space budgets are increasing. Satellite constellations are exploding. The US government is prioritizing domestic launch capability. Rocket Lab is in the right place at the right time. The bear case, number 1, the valuation is insane. 48 times forward revenue. For context, Boeing trades at 1.5 times revenue. Yes, Rocket Lab is growing faster, but this is SaaS level valuation for a hardware company. Number 2, they're not profitable and won't be for at least 2-3 years. Cash burn is real. If Neutron gets delayed significantly, they might need to raise capital, which means dilution. Number 3, SpaceX is an existential competitive threat. If Elon decides Rocket Lab is a problem, he can price them out of the market. Number 4, execution risk on Neutron is high. They've never built a medium lift rocket before. The technical challenges are real. One catastrophic failure on the pad and the stock could drop 40%. Number 5, the stock is priced for perfection. Any delay, any contract loss, any margin compression, the market will punish it hard. Number 6, insider selling. Yes, it was planned, but it's still a signal that people with perfect information are taking chips off the table. Number 7, lack of profitability moat. Unlike SpaceX, which has Starlink as a captive customer and massive internal revenue, Rocket Lab is dependent on winning third-party contracts. That's harder to scale. And number 8, the stock has already run 244% in the last year. A lot of the good news is already priced in. So which side is right? Honestly, both. This is a high-risk, high-reward trade. If Neutron succeeds and Rocket Lab executes, $105 looks cheap in 3 years. If Neutron struggles or SpaceX undercuts them, $60 is very possible. It's not a set-it-and-forget-it stock. It's a growth stock that requires active management. So here's what I'm watching over the next 90 days. February 26th is the Q4 earnings call. This is the catalyst. We need to hear updated Neutron timeline, Q4 revenue and margin trends, guidance for 2026, any new contract announcements, and defense pipeline commentary. If they announce a Neutron delay beyond mid-2026, expect a 10 to 15% drop. If they reaffirm mid-2026 and announce another major contract, we could see a breakout above 95s. Technical levels to watch. Support at the 50-day moving average, 67.7. If we break below that, the next stop is $60, which is the 200-day. Resistance at 90. We tested it Wednesday and got rejected. If we can break and hold 90, the next target is the all-time high at 99.58. Volume is key. If we break 90 on high volume, that's confirmation. On low volume, it's a fake out. My personal trading strategy, not financial advice. I'm in 2 camps on this stock. If you're a long-term investor with a 3 to 5 year time horizon, I think dollar cost averaging into this on pullbacks makes sense. Buy a third of your position now at $88. If it drops to 75s, buy another third. If it drops to $65, buy the final third. You're betting on the 2027-2028 story, not the 2026 story. And in that time frame, Rocket Lab is either a 150 plus stock if Neutron works, or a $40 stock if it doesn't. If you're a swing trader, wait for the February 26th earnings. We're in a consolidation pattern right now. The breakout or breakdown will happen after we get clarity on Neutron. Personally, I have a small position here. I'm waiting for earnings. If they deliver on the call, I'll add aggressively. If they disappoint, I'll wait for $70. The one thing I will not do is chase this above $95 before we have proof that Neutron is on track. Catalysts to watch beyond February: Neutron arrival at Launch Complex 3 in Virginia in Q1 2026, first hot fire test of the full Neutron stack, maiden flight announcement, any new defense contracts, potential SpaceX IPO news. This lifts all space stocks. Electron launch cadence: if they hit 25 plus launches in 2026, that's huge. and one wild card, Trump's Golden Dome missile defense initiative. Rocket Lab is positioned perfectly for this. If they win a Golden Dome contract, add another 20% to the stock immediately. Look, here's the bottom line. Rocket Lab at $88 is not cheap, but it's also not crazy. This is a company that's growing 48% annually, has a $2 billion backlog, just landed an $816 million defense contract, and is on the verge of launching a rocket that could 10x their addressable market. The tank test was noise, the trend is intact, but you have to be comfortable with volatility. This stock can move 15% in a day on headlines. If you can't handle that, this isn't for you. For me, the key question is simple. Do you believe Peter Beck can build Neutron and launch it successfully? If yes, this is a massive opportunity. If no, there are safer bets in aerospace. I believe he can do it. The track record with Electron speaks for itself. The engineering talent is real. The contracts are real. The market opportunity is real. But I'm not betting the farm. This is a 5 to 10% portfolio position max. Wednesday's bounce to 88.57 shows the market is looking past the tank failure and focusing on February 26th. I'm doing the same. So that's my take. What's yours? Are you buying this dip, waiting for earnings, or staying away entirely? Drop a comment below with your strategy. I genuinely read every single one. If this deep dive was helpful, smash that subscribe button. We're going deep on high growth stocks every week and you don't want to miss it. Thanks for watching, and I'll see you in the next one. To the moon, or back to $60. We'll find out soon.